Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 85. And this week on the podcast, we return to our installment series on investing myths. And specifically this week, I wanted to dedicate an episode to this concept that you need to keep up with the financial media in order to achieve the best investment returns. It seems intuitive, but unfortunately, the more that you follow the financial media these days, the farther astray you are often led. So this week is a shorter episode, but it's one that is important enough that I wanted to dedicate an entire week's episode to. So I cover this in a little bit of detail, but it's an important concept if we're going to do justice to covering the top investing myths that I run into and that I think are present around the world, certainly around the country and probably everywhere. This is definitely one that we had to cover. I hope you enjoy it. Hey everybody, real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. All right, so we're back on the podcast this week, back on our Investing Myths series. This is the third installment of this series. I expect to continue this maybe throughout the end of the year, not really sure. I'm just going to kind of riff on various investing myths that I run into in my life and my day-to-day here in the financial planning firm. And this week on this installment, series of installments, is the myth that it's really important to closely follow everything that's going on in the financial media all the time. And alongside that, this concept that the more closely you follow what's going on in the financial news, the better your investment outcomes and results are going to be. And flatly, that's not the case. Because the logic here is that the more closely that you follow the stuff, the more that you learn about the markets, the more you truly understand what's going on. And I'm not saying that more knowledge is not good. It absolutely is good. And if you're interested in this stuff, there's no reason not to learn about it and dig in as deep as you want to. The problem with it is that the deeper you dig, the farther you go, and the more you're tempted to make these short-term tactical adjustments to your portfolio. And that very often, leads us to bad outcomes. There's this difference I've talked about on the podcast before between strategic strategies and tactical strategies. And think of your strategic strategies more as your core strategy. I want 70% of my accounts in stocks, 30% in bonds, maybe a little touch in real estate. And that's my allocation that I want to stick to through thick and thin. That's a strategic asset allocation that's meant to be consistent over the long term. A tactical strategy is one where you're saying, well, the euro went up last week. I think that the debt over there in Denmark is changing by enough that we're going to make these short-term movements, or whatever your thesis or hypothesis might be, you're making short-term bets based on the circumstances, and you're constantly interpreting new information, new data, and then making an adjusted investment decision based on that. That's more of a tactical strategy. And I'm not someone who just dismisses tactical strategies entirely, because they can be helpful to some people, some institutions, some entities out there as a complement to your core strategy. But you need a core strategy in the first place that acts as that rock and gives you consistent exposure to a consistent set of asset classes to start with. And if you have a tactical strategy, it should go maybe as a byproduct of that initial strategic strategy. So what I'm getting at here is the more that you dig into these financial media sources that are really click farms these days, and I'll probably rant on that here in a few minutes, but the more that you get into it, the easier it is to make some of these short-term tactical moves. The more news articles you see, well, here's an idea about that stock. This looks tempting. Kramer is saying that it's time to buy this one right now. It's very hard to stay away from those short-term thoughts, because the whole premise of financial media today is to get you to take short-term actions by watching the network so they can put commercials in front of you, or by clicking here for them to sell advertisements on their websites. That's the model these days. And I'm not well-versed or smart enough to really truly understand what's going on in media today, but I'm sure every single one of you has noticed that over the last decade and more, the media industry has gone from one where there used to be a lot of quality journalism around a lot of publications, and now it's often hard to find that. And you go to any of the major networks, CNN, .com, any of these places, and they're click farms where, yeah, maybe there's some good journalism in there. Maybe they're reporting on events in a semi-accurate way, but it's all very biased, and it's all structured with clickbaity headlines to get you to go to various places, because the more places that you click, the more ads that these websites can sell. So it's geared toward driving these short-term behaviors. And on a place like CNBC.com, and I pick on them a lot, it's really any of these major news networks that have financial arms to them. Their whole existence is to get you to take these short-term actions and click around and watch this ad so that they can drive revenue. And that kind of short-term momentum makes it hard to stay away from short-term trading decisions that will, in general, not 100% of the time, but in general, kind of lead you astray from what a core long-term investment strategy should look like. So there's just this pervasive concept out there that the more you know, the better you're going to do. And again, I'm not trying to dissuade people from obtaining more knowledge and learning about what's going on in the markets and their certainly their own accounts and what's going on in the world and all that. That's well and good. My point is more that we need to be really thoughtful around what we're putting into our brains, what we're synthesizing, and what the source is. And I don't pay, personally, the way that I try to handle it here, if somebody sends me an article from one of these places, I'll look at it. Every now and then, if there's like breaking news somewhere that I'm just trying to, get the freshest new data on, I'll go to like CNN.com every now and then and look at that. But if there's anything beyond that, where there's a news story that I want to know about and learn about in the markets, say the Federal Reserve met, or there's been a big movement in meme stocks or something else, any of that editorial stuff, I am trying deliberately to only digest it through sources that I pay for. And that's really important. There's a really good quote out there. I don't know who to attribute this to. It's definitely not me. But someone out there really smart said something like, if you're not paying for your news sources explicitly, then you are the product. And that's exactly what's going on here. It's free to access any of these sites. If you have a cable subscription or streaming or whatever, you can watch any of these news networks. But if you're not going through a paywall to access good quality content, then you're the product that the networks are selling to their advertisers. That's just very simply how the model works right now. All the good quality, as objective as you can get these days, content goes through a paywall. So we pay at the planning firm for a subscription to things like Wall Street Journal and Bloomberg and Financial Times, and the good quality content out there you have to pay for. But I just feel like it's so important these days to be cognizant of what you're synthesizing and what you're trying to, the sources you're trying to learn from. Because if you don't, there's always some ulterior motive there beneath the surface that might not be terribly apparent. The worst case scenario is social media. There's the same clickbaity headlines are amplified on social media, and if you're obtaining your news and being influenced by that, that's not a good thing, because it's either a party that's benefiting from your clicks, or maybe it's a bot from another country who's trying to enrage our general public, or whatever the case may be. But there's just a lot of crummy sources out there. So this is going to be a short episode this week, but my point is that we have to be really cognizant of what sources we're obtaining information from. All of them are going to be biased, but I feel like the Wall Street Journal is still a very, very good source, very middle of the line politically. Their commentary and opinion pieces are pretty right-leaning. Financial Times and Bloomberg, also very, very good sources. But we have to understand that if we're going to, bump around the internet to do our learning, we just have to understand it for what it is, because every single source is going to have a little bit of a bias. And if we're obtaining our information and doing our learning from these click farms, that's a source that is trying to get us to make short-term behavior, and it's very hard to stay away from tactical short-term decisions over time. So that's the long and the short of it for today. This is probably going to be the shortest episode that we've done to date on the podcast, but it's an important topic that I wanted to cover. It's one that I just see people consciously and unconsciously falling victim to. The major news networks are kind of hard to stay away from, and some of our clients will say, I just want to learn and understand what's going on. I know I'm not, supposed to trade actively, and I don't let it influence me. I understand where it's coming from. Well, that's all well and good, but subconsciously, that source ingested over and over and over again every day can start to do some damage and push you in suboptimal directions. So that's the idea. We're going to have more of these investment myths installments, like I say, throughout the year. This is one I probably could have crammed together with another topic, but even though it's short, it's important enough that I wanted to dedicate a standalone episode to it. So that's it for this week. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.